Hello, this is Helen Disney, co-host of the Financial Markets Insights podcast, which is brought to you by the Realization Group. Here, we bring together the best minds in the financial and capital markets industry to discuss all the latest trends and news. Your podcast host today is Jannah Patchay. In episode 2, she'll be examining what happened when trading in a little-known company called Gamestop created a short squeeze and asking our special guest, Lee Schneider, for his views on what it means for the future of financial markets infrastructure. Enjoy the show.
Today we're welcoming Lee Schneider, General Counsel at Block One, and also a co-presenter of the Appetite for Disruption podcast. We're very excited to have Lee here today talking about Gamestop and what it can teach us about financial markets infrastructure. In January 2021, a video games company very few people had ever heard of made history for one of the largest share price increases in stock market history. Apart from making headlines around the world, the GameStop story and how it played out has thrown up some key questions about the future of financial markets infrastructure. How did it happen and why? In the first COVID-19 lockdown, many traditional retailers suffered from store closures, and GameStop was no exception. On the face of it, the company's old-fashioned bricks and mortar business model seemed broken, and its stock was at its lowest ever level, trading at between $2 and $4 a share. Meanwhile, over in a subreddit forum on the internet, retail traders who disapproved of the behavior of institutional investors and hedge funds who were short-selling GameStop stock decided to have some fun of their own. Members of the Our Wall Street Bets group agreed to purchase as much GameStop stock as possible and not to sell it. This would reduce the number of available GameStop shares to the point that short sellers would have difficulty finding stock to buy or cover their trades. The result was a short squeeze, similar to what famously happened with Volkswagen in 2008 when its stock shot up 93%, although with rather different causes. While some members of Wall Street Bets were certainly interested in making their own returns, many saw this collective action primarily as a form of digital protest against the power of the mighty hedge funds and as a way of punishing the types of high-rolling investors who engage in short selling. Some commentators have even seen it as a generational protest, pitting younger millennials against the boomers. Although GameStop received the most attention, other heavily shorted stocks, so-called meme stocks or nostalgia stocks, targeted by amateur investing forums, also got caught up in this period of frenetic activity. Companies including AMC Entertainment, which owns Odeon Cinemas in the UK, American Airlines, BlackBerry, Nokia, and an American homeware store called Bed Bath & Beyond were all affected. GameStop has sparked a wider discussion about the so-called democratization of investment. Apps like Robinhood, which came to play a central role as a broker in the GameStop story, allow retail and amateur investors to readily gather information and trade in options with no commission at the click of a button and around the clock. When trading got so out of hand that the New York-based hedge fund Melvin Capital was about to go bust, Robinhood called a halt to the trading of certain stocks and was closely followed by other trading apps who blocked and restricted sale of GameStop and other stocks caught up in the Reddit rally. The decision was especially significant since around 50% of Robinhood's 13 million users reportedly hold GameStop stock. Although the behavior of the Reddit investors, many of whom traded on Robinhood, was not technically illegal, such coordinated buying strategies could be considered a form of market manipulation and also raise wider questions for regulators about the mental health impact on potentially inexperienced investors when things go wrong in ways they may never have anticipated. The market volatility created by GameStop unsurprisingly drew the attention of US regulators who held a hearing in Congress to get to the bottom of what happened. While the Securities and Exchange Commission also announced it would assess the situation and review the activities of regulated entities, financial intermediaries, and other market participants. During his congressional testimony, Robinhood CEO Vlad Tenev admitted that the business halted buying on its platform because it did not have the funds to back the huge influx of trading created by the Reddit frenzy. Regulators now have important questions to answer about the role of hedge funds, the collusive behavior of retail investors, and their exposure to trading risks via platforms like Robinhood, as well as the serious ongoing legal and financial consequences for US financial markets. Despite further congressional hearings being planned, GameStop shares surged again on the 25th of February as the trading mania returned. The Gamestop saga is not over yet, and its ramifications look set to continue affecting financial markets for some time to come. So Lee, thanks very much for joining us today. And I know
Thank you for having me.
I know this is a subject on which you have lots to say, so very much looking forward to hearing your thoughts on this. Looking at this first from the perspective of the Wall Street bets investors, did the markets actually fail retail investors? Or did they function as expected in a period of exceptional market activity by suspending inadequately collateralized trading activity in an unusually volatile instrument?
I guess that question is really a matter of perspective. I think there were a lot of the retail investors who thought that the system, quote unquote, the markets failed them, especially when Robinhood stopped trading and many other platforms stopped allowing trades in GameStop and other stocks. On the flip side of it, from a regulatory standpoint, maybe regulators think that the markets functioned as they are supposed to function because of the excessive trading and volatility, which resulted in an excessive amount of risk in the system, which in turn resulted in the margin calls that caused Robinhood and other platforms to stop the trading. So it really is a matter of perspective. One of the things I think that often gets lost in the thinking about trading on the stock markets is, even though you can trade pretty seamlessly directly on an internet platform, there's a whole bunch of back-end things that need to happen, particularly with respect to the settlement of the trade. That is to say, when the cash and stock are exchanged. And those things happen over the course of several days. And so there's some risk built into the system. And that was exacerbated in the GameStop situation because there was so much trading and so many people were buying shares and selling shares that there was a lot of risk in the system. So the regulatory brakes put the halt on things.
Thanks very much. And there's been a widespread perception on the part of retail investors and many members of the public that the markets are rigged against them, that they were treated hideously unfairly, and that this is just symptomatic, specifics of the situation aside, this is just symptomatic of the wider structural bias of the markets towards institutional investors and away from retail investors. In your opinion, is there any truth in that?
Well, I mean, that's a pretty big statement. You know, is there bias against retail investors? I don't know that we would necessarily say that there is bias against retail investors. There may be some bias in favor of institutional investors, though, because they are moving massive amounts of money. You know, just like a large purchaser is more likely to get a discount on the goods that they purchase as opposed to a small purchaser, often that can be the case in financial services as well. That may not be a good reason, but it is a reason why things happen a particular way. I do think it's important, though, to any discussion here, to keep in mind the amount of risk that is in the system as a whole. And so what the system is designed to do by regulation is to damp down that risk so that the system makes sure that everybody's trades get settled. And it's one thing to push buy on your internet platform or in your app. It's another thing to actually have those shares credited to your account and to have the money deducted from your account. And so we often think of those things as happening together, but in fact, they don't happen together, at least not in the traditional financial services system. And some of the things that are happening in the blockchain world, in the DeFi world, there is that immediacy of transfer.
So you raised some interesting points here, and it is moving a little bit away from GameStop, which we'll return to in a minute. But I just don't want to lose this train of thought here around the efficiencies that can be introduced efficiencies to market structure, efficiencies to settlement, etc., that can be introduced through the emergence of digital assets, decentralized finance, and that whole world that's emerging around the applications of blockchain to financial markets. Do you think that there is a genuine opportunity there to open up greater democratization of finance? And relating that back to the GameStop situation, would some of those opportunities that are opened up by new forms of decentralized finance, would they alleviate some of the concerns that investors and the public have had around GameStop?
I think there are some really great opportunities with decentralization and blockchains. So if we sort of think about the internet as originally a way to communicate information, but not to exchange value, what blockchain does is it allows us to exchange value over the internet. And so it allows, although it does not require, by the way, but it allows individuals to participate more directly in transactions at the base level. And it allows for peer-to-peer transactions as opposed to transactions where there's some type of intermediary or other party involved. And so with all of that, you can certainly expand the amount of opportunities that there are for people to participate directly. I don't know that I necessarily call that democratization. Maybe I would call it inclusion as opposed to exclusion. And so when you have a situation where anybody with a computer and an internet connection can buy and sell assets or otherwise transfer value on a public blockchain, that certainly increases the amount of inclusion that's available. There's nobody monitoring. There's nobody saying, no, you can't join. It's just a question of having the equipment.
And in principle, that sounds absolutely fantastic. But in practice, do we actually want greater inclusion and participation in the markets? How do you balance that? On the one hand, that desire that we should have to make markets work more fairly with everyone, with also concerns around consumer protection and the impact that massive losses on the stock market can have on the financial, physical, mental well-being of small-scale investors?
Look, those are really important questions. I think often people in the traditional financial markets, including regulators, are very much focused on this idea of quote unquote investor protection and how do we make sure that investors, particularly retail investors, don't suffer some of the big losses and problems that we all know can arise from investing. Similarly or differently, when you don't have a large regulatory framework, when you don't have a lot of intermediaries to enforce these kinds of strict rules, you do have more personal choice. And so maybe having more personal choice is a better thing. I think, frankly, it's up to each individual to make decisions about what they want and what they can do. But that said, I also don't want to live in a world where somebody can take unfair advantage of me or anybody else. And so balancing those issues are really important policy considerations, both in the traditional finance world and with respect to things like the GameStop situation, but also in the decentralized finance world and the world of blockchain.
So I guess we've covered off one prong of regulatory concern, which is the investor protection side of things. On the other hand, you've also got market abuse, market manipulation. So in your view, to what extent do the collective actions of the Wall Street bets investors constitute market abuse or an attempt at market manipulation, which is also something that's been raised?
Yeah, I would say they probably don't, at least under the current definitions of market abuse or market manipulation. Typically, what we look for there is a small group of people who set out with some wrongful intent to manipulate the market. So the classic is the pump and dump scheme, where a bunch of people get together and they decide they're going to pump up the value of a stock, either by trading it a lot or by putting rumors out into the marketplace or false information out into the marketplace, or a combination of the two, to make the price go up. And then they sell at the high and everybody else is left holding the bag as the price plummets when reality sets in. That kind of manipulation does not seem to have occurred in the GameStop situation. It seems like there were a lot of people on this one subreddit, and they all started trading. Now, it was perhaps in a coordinated fashion because they were all starting to trade at the same time, and they were all looking at what each other was doing and cheering each other on and whatnot. But that does not seem like the classic kind of market manipulation that would violate the securities laws, at least in the US. Is it a form of market manipulation? It's really hard to say. With these open marketplaces, part of what happens is when you buy a stock, you're hoping that everybody else is going to buy it, because when everybody else buys it, it goes up. When you're selling a stock, you want to sell at a point when it's will get you a high price, as opposed to selling at a point when it's going to get you a low price. And so you want to try to sell when you think, but at a point before you think it's going to start going down. So there are all of these kinds of things that happen in markets that are the result of collective action. And people are trying to time the markets based on what they think that sentiment is, what they think the collective action is going to be. So it's, very tough for me to say that there was market manipulation here. Should I say something super controversial?
Go for it.
Because I'm not being controversial here, and yet so far.
I was going to ask you some questions aimed at making you say something controversial, so don't worry about that. But do go ahead and voluntarily be controversial.
No, look. There's people. People get involved in marketplaces often with insufficient information. It doesn't matter if it's the stock market or some other type of financial instrument, or the market for anything else. There's lots of things that people trade. There's lots of things that people invest in all the time. When they're trading and investing, they're hoping for some kind of a profit. That often does not work out, but sometimes it does. And part of having relatively free markets is that some people are going to get run over. And if we're going to make a choice to have free markets, we also have to live with the choice that some people are going to get run over.
I think that is a good point. And again, that goes back to the investor protection imperative of regulators and that need to balance opportunities for access to financial markets and access to capital growth with genuine understanding of the risks associated and protection for investors who are unable to understand those. I guess, I find it, sorry, go ahead.
No, I was going to say, often we think that we can cure these things with information and disclosures, both of which I think are hugely important. We need lots of information and lots of disclosures, regardless of what the market is.
Your average retail investor isn't actually, your mum or dad is not going to sit around and actually read all that information and disclosures, are they?
Well, and by the way, sometimes your sophisticated traders aren't either, right? I mean, I've been a financial services and lawyer for 20 plus years, and I still make emotional decisions about whether or not I'm going to buy something or sell something, et cetera, et cetera. And I am often doing that based on no information or very little information. Right. I'm often doing that because a friend of mine said something, or I saw something in a chat room that I participate in, or I heard something on Clubhouse or whatever.
Fear of missing out.
And well, I mean, in some ways it's fear of missing out. In other ways, it can be, somebody said something that I think is really intelligent. And so I want to follow an investment strategy based on that intelligent thing that somebody said. And, I do it just with the thought process that goes on in my head and with what I heard from the person I think who said something intelligent, as opposed to then going out and saying, all right, he or she said X. Now I'm going to do a ton of research and figure out what my trading strategy is based on X. More often than not, it's he or she said X, so I'm going to go do Y now.
So Gamestop, I mean, I do really want to know your opinion on this. What really happened there? There's some members of the Wall Street Bets Reddit group who are saying this is really about the company fundamentals. They believe that this was an undervalued and underperforming company that did have legs in it. GameStop itself seemed rather bemused by the whole thing, since they were expecting to be on their way out, and if you actually look at the company fundamentals and the environment in which the company is operating, it doesn't look like it has a long-term sustainable model. So if this wasn't artificially pumping a share for, in order to dump it at some point, and I'm sure there was a bit of that going on, then what was it really? What was behind it? Yes, there's giving the finger to a bunch of hedge funds, but were those are those collectively reason enough for so much money to have gone into propping up GameStop?
I mean, that's a good question. I wish I knew exactly what happened. I don't think anybody's ever going to know because it's all stuck in a lot of people's brains or maybe if somebody spent enough time reading all of the posts in that subreddit, they would be able to cobble together what actually happened. But look, this is the way markets function, right? There is a pandemonium about the functioning of markets. If you've ever been to an auction, there's a pandemonium about an auction. If you've ever been on the floor of the New York Stock Exchange, although not so much now anymore that everything's computerized, but there's a pandemonium around it, and people are trying to make split-second decisions about what they want to do. Sometimes it's with clear strategy, and sometimes it's not. But the general view that we take in the US and in other quote unquote market-based societies is we want those markets to happen. We want that trading to happen so that most of the information gets subsumed into the price of an item. And that price can happen, that pricing, that information can happen in lots of different ways. Some people with expertise, some people without expertise, some people who believe in something, some people who don't believe in it at all, right? All of that's happening simultaneously. Personally, I think that's a lot of human nature, right? And while I don't necessarily agree with the direction in which human nature pulls us sometimes, and I often try to put the brakes on some of my sillier impulses, that's sort of what ends up making us human. And to some extent, regulators or anybody else looking at the GameStop situation and saying that's bad is effectively saying that, what human beings do is bad, or the way human beings are is bad. And I'm just not prepared to go that far. I don't like everything human beings do. I don't even like everything that I do, but I also don't think that everything is bad.
That's an interesting take on it. The humanitarian argument for GameStop.
Well, I don't know that it's humanitarian, but I think it's recognizing
yes.
fundamental things about people. I mean, look, that's part of what regulators have to try to do, right? And policymakers, they have to try to recognize things that are fundamental about human beings, which, by the way, are constantly changing because human beings are constantly changing, and developing policies that suit what the world is like, and a vision of what the world might be like. It's a tough job. I'm glad I'm not a regulator.
Yes, it is a challenging time to be a regulator. And going back to the regulator's point of view on this, looking at the more kind of systemic impact of what happened outside the microcosm of the Wall Street Bets group, there have been reports in the media that the actions of that group in pumping up the GameStop price ultimately created risks for prime brokers. So those are the banks that service the hedge funds who were shorting GameStop stocks. And the prime brokers themselves are systemically important financial institutions. So this could have led to systemic impacts and possibly even, systemic events and failures if it was left unchecked. What are your thoughts on that?
We definitely need more prime brokers so that they are not systemically important. We need to spread the risk around. This is something that I think everybody learned in the 2008 financial crisis, or said that they learned in the 2008 financial crisis. And to some extent, those lessons are being carried out in policy and regulation, but to some extent they're not. We still see large banks that control large swaths of what goes on in the financial system, and I don't mean that as bashing them or not. My point is, we need to spread the risk around better, and particularly when that risk is not just to the bank itself, but it is to everybody in the marketplace because of what the bank is doing. So there's certainly a lot of things to think about. By the way, part of the ethos around blockchain and decentralized finance is that it does spread the risk around. There's just individual actors. There's not actors who are agglomerating risk together, and everything should be fully collateralized. Although, as you know, I've written an article where I point out that things are not always fully collateralized in DeFi, just like they're not always fully collateralized in the traditional financial markets.
Thanks. And that actually segued quite nicely into my final question for you. So we've talked a bit about the potential that new forms of financial systems, such as DeFi and digital assets, hold for addressing some of the questions and challenges raised by the GameStop events. And looking at that more fundamentally, I mean, the whole concept of short selling, the way that short selling works, is predicated on the idea that you've got some settlement time that's greater than zero, because you short sell something you don't have on the assumption that the price is going to fall, and therefore when the price is falling, you'll buy it and then you'll settle the trade that you entered into when you didn't have it. If you have instantaneous settlements, though, as you would with digital securities, could these same events have even unfolded, and could they have unfolded on a decentralized trading system? So, I guess my question is, to what extent can this next step in the evolution of finance actually eliminate the root causes and drivers of some of these strange events, such as GameStop in the first instance?
Yeah. So the short answer is sure. Lots of different things can happen in decentralized platforms. You could get, for example, a subreddit going about the trading of some blockchain asset, blockchain token like Bitcoin or Ether or EOS tokens or whatever. But and you could have sort of the same effect where you see the price skyrocket. Short selling is a bit more difficult of a proposition in blockchain, and so figuring out exactly how to do that takes a bunch of steps and a bunch of intermediaries that would probably mean that trades on a blockchain would not be particularly affected, or on a DeFi protocol would not be particularly affected, but activity off chain might be strongly affected. So you can certainly see how the same forces could be at play on chain as off chain, or at least have impacts on chain as well as off chain. But that's I think that's a topic that would require a lot of thinking and a lot of discussion, and probably we don't have enough time to cover that. But let's do a clubhouse room, and we can get together with lots of people and talk about it.
Sure. I know you said that. I said that was my last question, but just one more to close to finish up on. And thanks so much for your insights on this. I just want to go back to the root of what GameStop said it was, what this whole Wall Street bets movement around GameStop purported to be about, which was the little guy basically coming out and standing up to the Goliaths of traditional financial institutions and hedge funds and say, no, we will not allow you to short this company and watch it go down. This is a form of activism, shareholder activism. To what extent do you think this is going to galvanize increased activism, not only because of the same drivers, but for many different reasons? People might have retail investors might have environmental reasons, environmental concerns that they want addressed as shareholders, things like that. I mean, it's really highlighted, hasn't it, the actions that individuals can take that can influence the outcomes and behaviors for a company, hasn't it?
I think that's a very good observation. And my sense is that we have moved very much to a financial world. We use financial metrics to judge many, many, many things. In part, I think that's because numbers are easy and people can sort of read them and feel like they have an intuitive grasp of what's going on. In part because numbers let you sort of keep score. And so, if you made more money than somebody else, that's one way of keeping score on something like that. Getting back to human nature, by the way. And so when people are quote unquote punished financially, as the Wall Street Bet subreddit tried to do somewhat successfully to the hedge funds that were shorting the GameStop stock, that can be a very powerful tool, particularly when financial results are what you're charged with coming up with. So, look, I think it is a powerful tool. It may have some interesting side effects, some of which may be that fewer companies will go public eventually. It's already been the case, I think, over the last 10 years that the number of companies that go public, or at least the time at which they go public, is getting later. The number of companies going public is comparatively fewer. So there are some interesting trends that need to be watched. By the way, I think even with private companies, often the financial levers are the ones that their investors, like the private equity funds or the hedge funds, et cetera, pull to influence behavior. And so all of that is very important to keep track of. And I do think that a form of quote unquote shareholder activism through trading as opposed to through voting is something that's kind of a cool new way for shareholders to try to get what they want.
So it sounds like Gamestop has given us, meaning market participants, regulators, the general public, all collectively, a lot of food for thought from a lot of different angles, and its impacts are probably going to be felt for some time. Thanks so much for joining us today, Lee. It's been great chatting with you as always.
Thank you.
And you had some really fascinating insights.
Yeah, no, it was a great discussion, and you asked great questions, so it was easy to have good insights when the questions are good. So thank you very much.
Thanks to all our listeners for joining us. You've been listening to the monthly Financial Markets Insights podcast. In our next show, Jannah Patchay and Hiranda Misra will be examining the extraordinary rise of the Special Purpose Acquisition Company, or SPAC. Subscribe to stay informed of all our future shows, and please do leave us a review, as your feedback helps us to improve the show and increase our audience. See you next time for more Financial Markets Insights.